Welcome to this jaw-dropping and frankly inspiring, maybe a little depressing, book report of The Problem of 12, a book about a few financial institutions that may or may not allegedly control everything. The problem is this. Right now, there are 4 index funds that own about 25% of all US public corporations. There are also about 4 private equity firms that own 20 to 40% of the US economy. Now, let me tell you, I've read this book cover to cover, front to back, every single word in this book. There are only 8 firms talked about. I'm not sure where the hell he got Problem of 12 from, but I promise you it's not in the book. I went to one of his lectures to make sure, and he said it was kind of a mistake. He really meant a few. So let's ignore that and move on to the greatest period in American history, the 20th century. Everybody knows it was great. There's a certain number of years named the Great Depression. There were not many jobs. There was not a lot of money, but what there was an American hero. FDR, the GOAT, rose from the ashes to save the US economy. He had a dream. He had a goal to lift America up by its bootstraps. How would he do that? Only one way. A lot of ways, but we're going to talk about one way, and that's through the Securities and Exchange Commission. He wanted a new regulatory body called the SEC to rule over public corporations in the United States. What did he want them to do? What groundbreaking methods was he employing? Well, he wanted them to write a report about financials and a bunch of other boring stuff. But more importantly, he wanted other reputable firms, and I'm talking really top-of-the-line reputable firms, to independently audit these companies and make sure that they weren't doing anything like, for example, committing fraud. Now, imagine you're some big corporate brass, some executive, some manager at one of these companies in the 30s and 40s, and you hear this news coming over the telegraph that there's going to be regulations. What do you think? What do you say? Well, they said, this is communism. What the hell? What are we, Russia? This is communism. America is capitalist. Everybody knows. There is no regulations. There is no oversight in capitalism. Anything more than that is communism. They hated it. They fought with FDR. There was a lot of battles, but the SEC got through. And where did that leave us? Well, it left us with a bunch of companies. Not any of these companies, but it left us with companies that were all separate. They weren't working together. They were regulated, sort of. They were audited for the most part. But they weren't working together, and they weren't owned by the same person or entity. Well, where did we go wrong? Let's talk about index funds. You have a few options when you get money. You can spend it, great option, or you can save it. Everybody knows of the classic under the mattress trick. Put your money under there, it's safe forever, can never get robbed or stolen from you. Well, if you want to make money, you can also go to a bank. You can get a little bit of interest, 0 to 5%, somewhere in that range. Or, my personal favorite, what I suggest to everybody, is day trading. This is separate from the book real quick, but I read a statistic somewhere recently. It was like 93 or 94% of day traders make money. So it's a viable option, okay? You could go that route. Well, you can also, if it's open to you, you can do this. You can inside trade, okay? Or what other people chose to do is invest their money with somebody else through an investment fund or a mutual fund, something like that. What this really entailed was a coked up finance manager choosing what stocks and what investments to make, and hopefully you making money and not losing a bunch. Then, around the 2000s, a new academic theory came to be called the efficient market theory. There's a lot of controversy these days about whether this is accurate or not, but essentially what it's saying is that the market knows everything. If you find out information online about rats are infesting all of the McDonald's in the United States, you can't then go to Robinhood and make money off that information, because it's already factored into the market. That's the theory. So because of this theory, a new investing strategy was born. Beforehand, people were just picking stocks, right? They were just saying, okay, Apple, I hope it goes up. Bed Bath & Beyond, I hope it goes down. Some people did a little better than others. But at the end of the day, this new theory called index funds was born. And it wasn't all that popular, but essentially what it was that a fund would follow a market or a certain portfolio of stocks, so that you weren't depending on the individual performance of any one stock. If Johnson & Johnson goes to 0 tomorrow, you have 499 other stocks to balance it out if you're indexing with the S&P 500, one of the most popular funds in the world. Now, there became a great man. He came out of the woodwork. His name was Mr. Vanguard, I think. And he created the company Vanguard. And Vanguard was the first company to publish an index fund that anyone could invest in. Again, this was early 2000s. They really weren't that popular. But advantages were starting to be seen. They were a lot cheaper for companies and people to invest in because they didn't require a money manager to be making decisions constantly. They were pretty passively managed. Now, over the next few years, something happened. The advantages became more and more apparent. people and corporations and organizations became to invest in them more and more. And that's how we ended up here. Now, there's these 4 companies that you see on your screen that own about 25% of all of the top companies in the United States. You might be thinking, okay, you've told me about all the advantages. I'm thinking this is great. Who cares if they own that much? Well, the problem is that ownership in a company means you can vote in company affairs. Now, you might be surprised to hear that much like the federal election, a lot of people don't vote in these elections. So that takes an ownership of 25% and actually blows it up a whole lot more because of all the people that aren't actually participating in the voting process. So when 4 companies have a huge controlling stake in the top 500 corporations in the world, it becomes a real big voting block. They control a large portion of the US economy. I would like to caveat that with saying they do not control these companies, okay? They make a very clear distinction. They don't control the companies. They influence them. Huge difference. So you're saying, okay, there's 4 companies. They influence a lot of the US economy. Do they work together? Do they collude? Well, no, I guess technically they don't actually participate in collusion. But that's kind of because it's really easy for them to communicate and coordinate without colluding. All of their votes that they participate in these companies' elections are published publicly. So each company can look at these records and kind of align their strategy with each other without actually having to talk. But luckily they get to talk because they have meetings, general strategy meetings about policy, not about any company in particular, but they have meetings about policy and kind of things they'd like to see going forward. So these 4 companies do work together a significant amount, but it's not collusion, it's more coordination, communication, working together. Okay, let's put index funds aside for a second. We'll get back to them, but let's talk about private equity. Private equity, I think, is a little bit less understood, so let me just try and explain it really quickly. Essentially, what happens in private equity is there's a big company, let's say Blackstone. They see a small company, let's say Fisher Veterinarian Clinic. They think, wow, we can make a ton of money with this company, let's buy it and do something with it. So they take it over, and now it's Blackstone Veterinary Clinic. What does that mean for the clinic? Well, usually what happens is they cut employees, they cut costs, in the hopes of generating revenue, and then in a few years, usually 6 years, selling it for a lot of cash for their investors. Now, these firms have really increased since the 2000s to present day, largely due to regulations from the Bill Clinton presidency. So structurally, what does it look like? Well, public investors invest in these companies. These are the 4 big private equity companies. They also happen to be public. Then they acquire other companies privately, like Fisher's Veterinary Clinic. Now, you might kind of catch on to something here. Well, this seems like a lot of public involvement. Yeah, it kind of is a lot of public involvement. How are these companies still private companies? How is it private equity? Well, they do a little trick where they kind of separate themselves by a level. They have these little junior companies. They're called private equity funds versus private equity firms. And these funds invest in the private companies, and they are privately owned. They're not owned by Blackstone. They just get money from them and put all their profits back into Blackstone. So it's a little bit of a little financial trickery, a little structural trickery to make sure that these companies are private still. Why is it so important that they're still private? Why do the companies care that much? Well, because there's really no regulations for private companies. They don't have to disclose anything to the SEC in the same level of the public corporations do, and there's a lot less oversight. As a result, there's a lot of discussion over, is private equity actually good or is it bad? There's not really a black and white answer, right? It's not good or bad. But there's a lot of studies and a lot of questioning on whether the returns are actually worth it. Because private equity, the theory is, it's riskier, so there should be higher returns. But in reality, taking away the higher fees for private equity, there's actually lower returns than the S&P 500. Then you also have to consider what economists call negative externalities. Negative externalities is just a huge, big, annoying word to say harm to third parties. What is the harm that private equity substantiates? Well, they fire a lot of people, right? They get rid of a lot of people. They cut wages. They often take shortcuts in working conditions and different regulations that are not as strict down at that level. Irregardless of whether or not you think it's a good or a bad thing, private equity, it's blown up over the past 20 years. These 4 companies own $2.7 trillion of the US economy, and private equity as a whole is about $12 trillion. Well, same question as index funds. Do they work together? Yeah, actually a ton in private equity, they work together. One of the things that these private equity firms do to kind of help each other and work together is one firm will bid really low on a company that the other wants to acquire. Then the firm that actually wants to acquire the company can do so at a much lower level. If that sounds like collusion, it really is. Then one of the most interesting ways they work together is in the sale of their businesses. Recently, 50% of exits, which basically means the private equity firm selling the company, 50% of those exits have been to other private equity firms. Essentially, it creates this big incestuous trading circle of these private equity firms just sharing the same companies around in a circle over and over and over again. I hope you have a good background. And you know what? You might be thinking, wow, there's no problem. This is great. The US economy is functioning perfectly. Well, there's a little bit of a problem. The problem is mainly in the control of the US economy and political landscape that these companies can exercise. In terms of the index fund companies that own a huge portion of public companies, they can pretty much call any CEO and at least get a conversation around different policies and different actions they want to see taken, because they have a large part in whether or not that CEO keeps their job. There was a really pivotal Supreme Court case in 2010 that allowed corporations to start spending money in federal elections, saying that that was speech, speaking for the hundreds or thousands of owners that these companies had. But based on everything you just heard, do you really think they're speaking on behalf of me who owns 2 shares? This allowance of corporate speech for the funding of different federal elections has really caused private equity firms and index fund firms alike to have a huge influence in the US government. As a result, they're basically able to lobby against different regulations they don't want to see. In 2022, firms just like this blocked the Inflation Reduction Act because it carried a rider that they really didn't want to see passed. They're also allowed to lobby for positive financial policies like different tax breaks for corporations that will greatly benefit them. It becomes a self-fulfilling circle where companies are able to basically get exactly what they want out of the government, giving them more control of the entire US economy. It shouldn't have to be stated that just a few companies controlling half of the US economy is a problem. But our boy John Coates, he does state that. And does he have any solutions for us? Like, kind of. I don't love his solutions just because, again, the companies have so much political power, and his solutions hinge on political reform. Essentially, what he wants is more disclosures. So private equity firms, he wants them to be forced to publish different metrics and different data on the companies they own. He wants a lot more disclosure around private equity firms. He also wants more frequent disclosure requirements for publicly traded companies. For index funds, he suggests that they disclose voting more often than annually, and that they publish their strategies for everybody to see, not just investors. Essentially, he sums up the whole problem as it's gotten really out of hand because of the lack of disclosure. As a result, his solution is to increase disclosure, increase regulation. But is it possible with the amount of control these companies exercise over the US government? I'm not sure. Neither is he. We'll have to find out. That was the book. Enjoy.